If you're watching silver like it's a normal commodity, you're already behind, because the next violent move won't begin with a headline. It will begin with a market opening. When liquidity is thin, rules collide with leverage, and the physical side quietly refuses to cooperate. Before we get into the vault math, hit subscribe and turn on notifications. Not as a favor, as your insurance policy. These moves happen fast, and this channel exists so you don't learn the rules after the doors lock. Now let's start with what just happened, because the most important signal was not the candle. It was the behavior. CME's own market commentary described silver hitting a fresh all-time high around 93.70 overnight, then dropping more than 5% early in the session, and then clawing back toward positive territory. That pattern matters. It's not random. It's the signature of a stressed market, paper volatility on the surface, and stubborn physical gravity underneath. So when you see a slam at the open, don't ask the emotional question, is silver dead? Ask the mechanical question, was that forced selling? Forced selling has a fingerprint. It does not care about fair value. It just liquidates. And right now, the system has multiple engines that can create forced selling right at the open. Engine number one is margin. Over the past couple of weeks, margin has been the hidden driver behind some of the ugliest tape you've seen. AP reported that when CME raised margin requirements in late December, silver and gold dropped sharply as the exchange responded to extreme volatility and demanded more cash to cover potential defaults. That's the point of margin. When volatility spikes, the exchange turns the collateral dial. But here's the part most viewers miss. CME isn't just raising margins, it's changing the way margins work. Market coverage explained that silver has become more expensive to trade because CME has been increasing margin requirements, moving silver's margin from roughly 7.2% to about 9% in a shift toward a percentage-based system. Plain language, when price rises, the collateral required rises automatically because it's tied to the notional value. That is a self-tightening system. The higher silver goes, the more it squeezes leverage. And when leverage can't post collateral, it sells. Margin calls cluster, and that's why opens can turn violent when liquidity is thin. Now, engine number two is index rebalancing. This is the cleanest insider explanation for why January can look chaotic on purpose. Barron's reported that silver faced potential selling pressure from the Bloomberg Commodity Index rebalancing window, scheduled for January 8th to 14th, 2026. JP Morgan analysts projected roughly $3.8 billion of silver futures could be sold as part of the rebalance. Read that slowly, not because the world woke up and decided silver is bad, not because demand vanished, because a rule book forces selling. That's what passive flows do. They don't sell because they're bearish, they sell because they must. And if you can predict forced selling, you can position around it. That's why the open becomes a battlefield. The selling is timed and mechanical, and deep pockets love to stand where forced selling is expected. Now, engine number three is retail crowding. Reuters reported that retail investors have poured record cash into silver, with nearly $922 million flowing into silver-backed ETFs over the past 30 days, and that Vanda Research described silver as the most crowded commodity trade. The iShares Silver Trust saw huge single-day retail inflows, and the rally has attracted both bullish and bearish retail ETF activity. This matters because crowded trades don't just move, they whip. Retail money isn't dumb, but it is often fast, and fast money reacts to candles, which means the market can weaponize the open, push price, trigger stops, force liquidation, then reverse. So here is the framework we use at the Metals Alarm Desk. We don't start with price. We start with rules, then flows, then inventories, then the chart, because charts are the painting, rules are the canvas. Now let's talk about the thumbnail question. Vault empty? Most people hear that and picture a warehouse with nothing inside. That's not the real fear. The real fear is deliverable flow. In the COMEX ecosystem, there's a difference between silver that exists and silver that is actually positioned for delivery against futures. CME's own advisory explains the categories clearly. Registered metal is metal that meets specs and has an electronic warrant issued. It's positioned in the reporting system as deliverable. Eligible metal meets specs but doesn't have an electronic warrant issued. It can be eligible for delivery, but it's not the same thing as ready and committed. In plain terms, registered is metal wearing a delivery badge. Eligible is metal inside the building, and the important question isn't is there metal somewhere, it's is deliverable metal behaving like it's comfortable or behaving like it's stressed. Now here's why this gets uncomfortable. CME's own market commentary pointed to a continued reduction in registered silver inventories that accelerated since October 2025 and highlighted an unusual physical withdrawal. 3.5 million ounces removed on January 7th with no offsetting inflows. That is the kind of detail insiders watch. Not because it proves a conspiracy, because it changes the probability map. If registered inventory is shrinking and withdrawals show up in chunks and inflows are not keeping pace, you don't need a dramatic story. You just need the math. But here's the second uncomfortable truth. Even if COMEX looks stressed, silver is global. And the biggest vault system isn't New York, it's London. A Reuters report on LBMA data said that at the end of December 2025, the amount of silver held in London vaults was 27,818 tons, up 2.3% from the previous month. That tells you something important. Metal exists. Metal moves. The world is not out of silver. So why are people still worried? Because the story is not total ounces. The story is friction. The story is flow. The story is who can get what, when they need it, under what rules. And this is where the insider angle becomes obvious. When markets are calm, no one cares about paperwork. When markets get tight, paperwork becomes the market. You can have plenty of metal in the world and still have a deliverable problem if the metal is in the wrong place. The metal is owned by hands that won't sell. Moving it requires time and cost, and export rules add delays. Which brings us to the geopolitical layer. China just gave the market a clear signal that silver is not being treated like a casual commodity anymore. A Reuters dispatch reported that China named the companies allowed to export silver during 2026 and 2027, a total of 44 companies, because Beijing deems silver critical to support its industries. That is not a ban, but it is a gate. And gates matter because gates convert supply into conditional supply. They add friction, they add paperwork, they add delay. And in a tight market, delay is a price driver. Now add another piece of global friction. India changed its import policy for certain plain silver jewelry and related items from free to restricted until March 31st, 2026, requiring licenses. Different motivation, different products, same theme. Governments are actively managing silver-related flows. So now look at the whole system at once. On the financial side, margins rise and self-tighten. Indexes rebalance and force selling. Crowded retail flows amplify whipsaws. On the physical side, registered inventories are being watched. Large withdrawals show up. London holds a huge stockpile, but stockpile is not the same as deliverable flow. China adds a gate on refined exports. India adds restrictions on certain silver imports. That combination creates one outcome: volatility at the open. Now let's make the Asia versus COMEX dynamic very simple. Asia is often thinner liquidity. That doesn't mean Asia is weak. It means price can move faster. It means gaps can form. It means stops can be hunted. Then COMEX comes online. That's when the heavy machinery shows up. Clearing-driven liquidation, margin-driven selling, index-driven rebalancing, options hedging, and big players absorbing flow. So you can see this pattern: an overnight push, a brutal early sell, then a recovery. That is exactly what CME's commentary described in the latest volatility burst, and it is exactly why your next big move may begin at the open. Now here's the part that really blows people's minds when they finally see it. The paper price can be smashed down while physical tightness stays in place. Those two can coexist. Paper trades expectation and leverage. Physical trades necessity. If a fund is forced to sell because of margin or index rules, it sells regardless of physical tightness. If an industrial buyer needs metal, it buys regardless of a fancy narrative. That's why the smartest question is not, did price drop? The smartest question is, did the market accept the drop? Because reaction tells you who is winning. If silver slams and stays down, forced selling is still in control. If silver slams and refuses to stay down, it's a different signal. It suggests paper pressure is hitting a wall of underlying demand. Now, since we're being honest and educational, we also need to say this: crowded trades can unwind fast, violently. Reuters noted that some analysts warned against over-optimism, given how quickly silver jumped from below $50 to above $80 in a short period, and how aggressively it has been moving. So this isn't a guaranteed moonshot. This is a stressed market, and stressed markets do not move in straight lines. That's why we don't worship targets here. We watch conditions. So what should you watch next? Let's make it practical. Signal 1, margin language and margin schedules. If margin keeps rising as volatility rises, that increases the risk of forced liquidation. If margin stabilizes, it can calm the tape. Signal 2, index rebalance window behavior. Barron's identified Jan 8 to 14 as the key rebalance window. Watch how silver trades during that window. Does the market absorb the selling, or does the selling control the tape? Signal 3, registered inventory behavior. CME's market commentary pointed to a continuing reduction in registered inventories and highlighted the 3.25 million ounce withdrawal. If withdrawals remain large and inflows remain absent, that is a stress signal. If inflows rise and inventories rebuild, stress can ease. Signal 4, the spread between what the screen says and what sourcing feels like. If physical is easy and premiums collapse, tightness is easing. If physical is delayed and premiums stay firm, tightness is still there. Signal 5, policy gates. China's exporter list is a gate. Any tightening, slowdown, or new paperwork burden adds friction. India's restrictions show how quickly policy can alter flow on specific product categories. Now, here is the disciplined way to think about vault empty without turning it into mythology. A vault doesn't have to be empty for the system to feel stressed. It only needs to become less liquid. Liquidity in physical metals is not just metal exists. Liquidity is the metal is in the right place, the metal is in a deliverable category, the metal can be moved quickly, and the metal isn't trapped behind policy gates. When that liquidity declines, the market can behave like a ration line. Price rises do not summon enough sellers, moves become jumpy, open sessions become dangerous, and the media starts calling it unexpected. But it's only unexpected if you refuse to watch the plumbing. Now, one more important update that matters for 2026. CME announced it will launch a 100-ounce silver futures contract on February 9th, 2026, pending regulatory review, and said it is designed to meet record retail demand. It will be financially settled based on the benchmark COMEX silver futures settlement price. This does two things. It widens access and it widens participation. More participation can mean more liquidity, but in crowded conditions it can also mean sharper emotional swings, because the more people are involved, the more stop runs and whipsaws become profitable tactics. So if you're trying to understand why silver feels like it's breaking the rules, understand this. It's not that the rules disappeared, it's that the rules are now the driver. Margins self-tighten as price rises. Index rules force selling during rebalancing. Retail crowding increases fragility. Physical withdrawals and registered trends change confidence. Policy gates add friction. And when all of that hits at once, the market doesn't move smoothly. It moves like a stress test. So what's the likely near-term setup? More volatility, more open-driven ambush candles, more headlines chasing the move after it's already happened, but also more opportunity for anyone who stops reacting emotionally and starts watching mechanically. Because if you understand forced selling, you stop panicking when you see it. You start asking, who was forced? How much selling was mechanical? Did the market absorb it? And what did physical do while paper was screaming? That's the difference between being an observer and being a student of the game. Quick disclaimer before we close. This is educational content only, not financial advice. Precious metals can be extremely volatile, and leverage can wipe accounts fast. Always do your own research and consider your risk. Now I want to leave you with two questions that actually matter, and I want your honest take in the comments. First, if silver keeps getting more expensive to trade through higher margins, who benefits most? The retail trader or the deep pocket that can absorb forced liquidation? Second, if vaults aren't empty, but deliverable flow is tightening, what breaks first? Paper confidence, exchange rules, or the price you see on screen? If you want the daily briefing style updates, opens, margins, vault signals, and policy gates, subscribe and turn on notifications. Because if the next shock move hits at the open, you don't want to be catching up. You want to be ready.